Alright, welcome back. You're watching First Trades live on ET Now. Let's connect with Jim Walker, founder and managing director of Asianomics, who joins us from Hong Kong. Jim, good morning. What a delight to have you back on ET Now. Jim, of late, India has seen a slew of GDP downgrades by foreign brokerages like CLSA, Citi and Crystal along with Moody's. Do you think a 6% target or a 6% GDP target is going to be tricky for Indian government to achieve?
Well, actually, those downgrades bring the sell-side brokers to the top end of our range of economic growth for India in fiscal year 13. Our message to clients over the course of the last 6-9 months has been that we should be expecting economic growth in the range 4 to 6% for fiscal year 2013. And I think we're certainly on course for something in that range. I'll be surprised if it's much higher than 5.5 this year, given what's happened in the first quarter, and especially what's happened with power outages through July.
Jim, hi, morning. The last time we chatted, you mentioned that you were cautious regarding the equity flows, or rather the liquidity flows for emerging markets. What would you say are the biggest concerns for FIIs looking at the Indian markets right now?
Well, I think the biggest concern still from foreign investors looking at India is the government and the lack of progress that the government has made in addressing some of the very clear issues in India, including electricity pricing. That's become much more evident through the course of the last few weeks. Subsidies that the government undertakes on oil and food and fertilisers, on controlling the fiscal deficit, and actually just in getting things moving at all on the infrastructure side. Policy paralysis is the name of the game in India, and I'm afraid that is one thing that foreign investors really hate to see, and it's one thing that's keeping them very much on the sidelines in India at the moment.
Jim, the cup is overflowing when it comes to domestic problems that India has to grapple with: a deficit monsoon, rising interest rates, high inflation, policy paralysis. So which of these problems could remain the biggest concern as viewed by global fund managers?
I think a lot of them are very much in focus at the moment. From our perspective, the thing that remains most worrying is the policy paralysis. The government really has not done anything over the course of the last 4 years to move India forward in terms of reform, in terms of implementing some of the policies that it said it was going to enact and implement right at the beginning of the term of this government. So the goods and services tax and the direct tax code, these are not even difficult things to introduce now. All of the groundwork has been done, but still we're waiting. So the government remains, I think, the main focus of attention. Inflation, people will be watching that with a view to the RBI and what it might do on interest rates. But in actual fact, if you look beyond or below the headline CPI and WPI numbers, you'll find that the RBI has well and truly controlled money supply and credit growth, and I think that will become less and less of an issue over the course of the next 12 months.
Jim, so out of growth opportunities available in emerging markets at large, BRICS, other South Asian markets, some of the African ones, how does India stack up in comparison, and has India slipped some notches from the stack?
I think India has slipped in terms of its status within the BRIC component. Certainly the consensus has been that China would be growing fastest, India next fastest, then perhaps Russia, and then Brazil, which has always been a relatively slow-growing emerging market country. And now everybody's looking at the slowdowns in China and India, and looking at the problems in Brazil, and the BRICS have been put to one side to a certain extent. Attention from foreign investors has shifted elsewhere amongst the emerging market universe. And I think quite rightly, because when we look at Southeast Asia in particular, places like the Philippines, Thailand, Indonesia, we see very solid fundamentals in terms of the debt position of those countries, fiscal debt, or sovereign debt, sorry, private debt. We look at the banking systems, which are also very solid, and we see a degree of domestic demand momentum in these countries. And so I think attention is shifting to the places where fundamentals and the debt dynamics look particularly good, and where there is a momentum behind economic growth and behind equity market performance, in other words, corporate earnings performance. And certainly Southeast Asia provides that more so than the BRIC countries at the moment.
So, Jim, what is your assessment? Do you think best of the BRICS is now behind us?
Well, I think it was always a bit of an acronym, and it was maybe an easy way to shorthand emerging markets generally, since these countries are so big. But the truth of the matter is that apart from about 1 or 2 years over the 2005-2007 period, the Chinese stock market has barely performed at all over the last decade. India has performed better, so has Brazil. But there are still problems in these countries, and I think that's been certainly highlighted again in the course of the last year or so. And Russia remains a bit of a mystery to many people, given the corporate structure there and the ownership structure. So these are countries